The Bank of Canada increased the overnight rate for the seventh consecutive time, bringing it to 4.25%. Hello everyone, it's Rasha Ingratta with Mortgage Intelligence, and in this video, I'm going to be discussing the recent rate decision by the Bank of Canada to increase the overnight rate by 50 basis points in the continuous effort to curb inflation. Along with the increase in the overnight rate, quantitative tightening is also being implemented, which in simple is decreasing the money supply in the economy. Another attempt to get supply and demand in balance. The CPI here in Canada is still higher than the target range between 1 to 3%. We have seen some ease up in the past couple of months from highs of 8.1 in June, but there's still work to be done to get it back into the 1 to 3% range. Now with this 0.50% increase to the overnight rate, an increase in prime will follow. The prime rate is now at 6.45%. Keep in mind that that isn't the rate you will be paying. To get your net rate, you'll have to subtract your discount from the prime rate. So if you have a discount off prime of 0.6% with the current prime rate of 6.45%, your net rate will be 5.85%. These rate increases have definitely impacted the housing market. Since February of 2022, housing in Ontario has dropped by 23%. But why has the housing market taken such a hit? Yet, transportation, groceries, and energy, along with other aspects of our economy, haven't seen the same drop yet. Interest rate increases impact different areas of the economy in contrasting ways. For example, rate increases almost have an instant effect on housing because they squeeze out the demand for housing. But when interest rates increase, there is usually a lag before the impact on inflation is felt and other aspects of our economy. This is because it takes time for higher rates to affect the economy and for people's behaviors to adjust to the new rates. For example, when the rates increase, people may decide to save more money rather than spend it, which will lead to a decrease in demand for goods and services. These decreases in demand will put downward pressure on prices, which will eventually can lead to a lower inflation. However, this process can take time to play out, which is why there is typically a lag between an increase in rates and inflation. It typically takes up to a year for interest rates to work their way through the economy and fully reflect in the monthly CPI report. So we haven't seen the full impact of inflation on our economy yet. One thing I wanted to point out is how Bank of Canada ended its past policy report versus the other reports earlier in the year. Past reports have ended like this. Given the outlook for inflation, the Governing Council still judges that the policy interest rate will need to rise further. Quantitative tightening is complementing increases in the policy rate. As the effects of tighter monetary policy will work through the economy, we will be assessing how much higher interest rates need to go to return to inflation to target. The Governing Council remains resolute in its commitment to price stability and will continue to take action as required to achieve the 2% inflation target. The most recent report ended like this. Looking ahead, Governing Council will be considering whether the policy interest rate needs to rise further to bring supply and demand back into balance and return inflation to target. Governing Council continues to assess how tighter monetary policy is working to slow demand, how supply challenges are resolving, and how inflation and inflation expectations are responding. Quantitative tightening is complementing increases in the policy rate. We are resolute in our commitment to achieving the 2% inflation target and restoring price stability for Canadians. So the main difference between these two concluding statements is the wording choice. The first statement used, the Government Council still judges that the policy interest rate will need to rise further. And the past report ended with, the Government Council will be considering whether the policy interest rate needs to rise further. So I think this is the first time out of the 7 rate hikes that they aren't sure what's next to come. They are going to see how the economy reacts to these rate increases and analyze the data before making the decision. Tiff Macklem, the Governor of the Bank of Canada, has stated that he'd rather raise rates too much than too little to avoid the risk of inflation to be entrenched in our economy, which in the long run will be more painful for Canadians. They are definitely walking a fine line between pushing the economy into a recession and not doing enough to curb inflation. If a recession does happen, rates will decrease to help out the economy through hard times. Mark your calendars for January 25th for the first rate announcement for 2023. I'm looking forward to seeing the CPI data that will be released, and I will be making an updated video to keep you in the loop. Finally, my opinion to go fixed or variable rate mortgage. If it's expected that we are coming to the end of a rate hike cycle, locking into a 5-year fixed rate mortgage wouldn't make much sense. I do still think variable rates or short-term fixed rates are the move to keep that flexibility rather than locking into the long term. Hopefully this video gives you a better understanding of where our economy is going. If it did, please like, subscribe, and share with a family member or friend who you think should see this. If you have any questions, please feel free to contact me at Rasha at Shopmortgages.ca or my team office at 519-250-4848. Have a great day. Rasha Ingratta.